Well, hi there. So in this video, we're going to be doing the introduction to banks. So banks I've kind of split into two parts here. The first part, we're just going to go through like, what do banks do? And then some basic ideas about when banks hold things that are of value and when they owe things to people as well. That idea of like a contract that banks have. So the financial sector is made up of not only banks, but it's actually a whole host of different kind of institutions and corporations. And kind of in general, what we would say is that it performs a really important function for society. So oftentimes, people who don't like, who talk about, wealth and poverty and things, they'll often say things like, bankers, that they don't, they just move money around, right? That they don't really add any value to society. But that's not true. They really do. They perform an important function in our society, and in particular for growing our economy. So the idea here is that when firms are like doing investment spending, so they're buying factories and machines, right? Or when the government is spending on things, they often have to borrow that money. And we know that consumers also borrow money too to finance their consumption spending. In general, that money comes from the savings of other firms and households. And so where do the dollars that end up kind of financing all this consumption and investment and government spending come from? Well, they come from people like you and me, people who save our money. And so there's an identity here, a mathematical identity, in fact, that in economics we call it the savings investment identity. The dollars, right, if you had something like disposable income equals consumption plus savings, we know that those dollars get transformed into investment spending, government spending, and consumption. That like eventually they kind of filter back into the economy in that sense. And in fact, the purpose of the financial sector is to facilitate that transformation. That's really what they do. And they match savers or savings with investment spending or borrowers. And they do that via a variety of financial products, things like loans, right? Loans are a financial asset in that sense. They reduce the transaction costs for a financial asset as well. If you're a saver, it's very difficult for you to go out and find all these little businesses that want to borrow money to expand their operations. It'd be very difficult for you to loan your money directly to individuals. That does happen. There are peer-to-peer lending websites actually that are out there, but they're quite risky, as you might imagine, right? Like if you loaned $10,000 to one person and they don't pay you back, then they're all gone. And so this third function, reducing individual savers' risk by creating a diversity of available financial assets, that's a really important function in that basically the bank takes your savings of $10,000 and splits it up among lots of different loans that then go on and do other more productive things. So obviously kind of an important function here in transforming savings into other spending. What we would say is that financial institutions like banks, but there are plenty of other financial institutions out there like credit unions, savings and loans. You could even argue that insurance companies and some other things are financial institutions, that they all earn money, and that banks in particular earn money by accepting deposits and then loaning the money out. So they take your $10,000 that you put in your savings account and they lend it to someone else. And they pay you a little bit of money, right, to kind of keep you happy and make sure that your savings stay in the bank. But then they charge a higher interest rate to the people that they loan the money to. And on the difference is where they make the money. That's really where financial institutions make their money on that kind of thing, or banks traditionally do. In the sense of how we'd kind of look at like what a bank does, we can actually use something called a T account that will help us understand that. I realize I haven't been clicking ahead here, but it's just the words. I think a T account is actually the easiest way to make sense of these two things, assets and liabilities. And just before we go too far into this, I will tell you the trick here is assets are something that is owned, and a liability is something that is owed. And if it helps you to say that many, many times in a row, I think that could be beneficial because you don't want to mix these things up, as you might imagine. Assets are something that are owned, liabilities are something that are owed. Assets owned, liabilities owed. Assets owned, liabilities owed. Assets owned, liabilities owed. It's really important that you know the difference between these two words. Now, in terms of what from the bank's perspective, right? So this is kind of complicated because many times students want to adopt like the hat of like a normal person. Adopt the hat of the bank because we're looking at it from the perspective of the bank. Assets are things that they own, right? And so these are things that are of value. So we can say these are things of value. And we would say that liabilities are things that the bank owed to someone else. And you might be thinking to yourself, like, how could a bank owe something to someone else? Well, they do, but we'll kind of get there in a moment. So things that the bank owns. The first thing that they own is they have something called required reserves. And this is basically, and I've written it out up here for you, the percentage of the demand or the checking deposits that the bank has to hold on hand, and they can't lend it out. Now, in real world, right? Actually, the institution that sets that percentage is the Federal Reserve. And the whole idea of it originally was that we didn't want banks to loan out all of the money that people deposit, because there would be people who will want to come in and they'll want to take money out of the bank. And so you have to have some money there that you can kind of provide. That required reserve adds a little bit of stability into the system. Now, the percentage that the bank has to hold is the percentage of the demand deposits. So we can actually figure out what that percentage is by looking at the comparison of those two values, of the 500 and the 1,000 that are right here. And in fact, I put that down here. Note that the required reserve ratio is 500 divided by 1,000. So therefore, the required reserve ratio is 0.5. Right? And if you're asked for a percentage, you would say it's 50%. And what is it 50% of? It's of the demand deposits only, right? Demand deposits only. Many times students will want to like add up a bunch of things on this side. It's just the amount of checking account deposits that the bank has, and it's a percentage of those that the bank has to hold. Now, in the real world, and this is not something that would appear on a test, but in the real world, actually, in just since 2020 with the pandemic, the rate that the reserve requirement was actually 0%, and it still is when I'm making this video here in 2021. It's 0%. So in theory, every time you deposit anything into your bank, the bank could loan out all of it. They can lend out all of it. They usually don't, right? And so this brings us to our second thing that the banks hold that are of value. And so they also hold excess reserves. This is any amount of extra cash that the bank is just holding on to that they haven't chosen to loan out yet. They could, because they're above kind of the minimum percent that the government requires them to hold. And they typically do. They before 2008, they usually didn't hold a whole lot. After the 2008 financial crisis, they started holding a whole lot more because they were worried that maybe their assets weren't as valuable as they thought they were. Now, in the last couple of years, right, they've held huge amounts of excess reserves that they've chosen not to lend out. And that's kind of a policy problem, and we'll kind of see why later in this unit. The other two things that, and by the way, I would just tell you these reserves, what they do with them is they deposit them at the Fed. So you have this Federal Reserve that's basically the banker's bank, and that's where this money is sitting. They actually have a bank account with the central bank. So there's a PNC bank account with the central bank. And that's kind of where this money is held. Some of it is held in physical currency at the bank branch locations, but the vast majority of it is just held in deposit at the Fed. And the other things that they own that are of value are loans. So when the bank makes a loan to someone, they're lending out money, but actually that's something of value to that bank because it's an income stream that they're getting, and it's something valuable, right? That they're promised that they're going to get repaid that money. And so it's kind of an asset. It's something of value. Think of it this way. If someone borrowed money from you, right, that's actually kind of a value to you because it represents future money that you're going to get back. Whereas from the person who borrowed the money, that's something that they owe. So that's a liability for the person that borrowed the money. So from the bank's perspective, loans are assets. They're things that are money, that aren't money, but they're of value. So they're assets of value. So loans and bonds, we already learned, are the same thing, basically. Sometimes you'll see them listed separately on this T account or the balance sheet. And what this is telling us is that this bank has made $1,000 in loans and they've made $500 in bonds. And so this is not money that they can loan out. Notice that I put this part here because over the years, sometimes students read this and they think, oh, that means they could loan out 1,000. And those kids have no idea how to read a balance sheet, but not you. You know how to do it. So this is money they've already loaned out. The last thing is physical assets owned by the bank, like equipment or property. And we can see that this bank has $500 worth of equipment or property or something. If we total it all up, we find that the total amount of assets of the bank are $4,000. That's the amount of stuff that this bank has of value. Now let's turn to the liabilities side. The way that we look at liabilities are things that they are owed to someone else. And from the bank's perspective, when you deposit money there, the bank owes you that money. At any time you could walk in and take your money out. And so the bank has to be kind of aware that like they owe you that in a contractual obligation actually to provide you with your money upon request. So there's demand deposits. We create that as 1,000 here, and that's just listed for us. And remember, we usually do see this separate because we kind of want to be able to tell what the required reserve ratio is. There's also often another line on the liability side for savings deposits. So sometimes it'll say savings accounts, or it'll say, certificates of deposit or something like that. It's basically everything that's not a checking account is going to get kind of listed also. And then you can see this other line called equity or owner's equity. Now, what we would kind of say is that assets minus liabilities, the things that are of value that you own minus the things that you owe to someone else, is equal to what we call equity. It's a fancy word that basically means the value of something. And so this is the difference, right? The kind of value of the bank in this case. We often line it up over on this side because that way we can calculate all of the equity and liabilities together and find that total liabilities has to match assets. And that's why we call it a balance sheet, because actually, this side has to balance with this side. Now, realistically, on a day-to-day basis, the amount of owner's equity will kind of fluctuate a little bit. And that's because basically the value of the assets and the liabilities will fluctuate a little bit. And whatever the difference between the two is owner's equity. Now, if the bank got itself into a position where its liabilities minus, not including the equity, of course, if its liabilities turn out to be larger than its assets, that would mean that the bank itself is bankrupt. That happened with some banks in 2008. In short, what happened to them was that sometimes they made loans and bonds and things like that, and then all those things just got wiped away. They became worthless when people stopped paying those loans back. And so if we had, in this case, imagine if this bank, that 1,000 and that 500 just poof disappeared, right? That those people said, nope, we're not paying you back, Mr. Bank. We're not giving you your money back. Well, now this asset side, it doesn't have 4,000 anymore. It only has 2,500. And we can look over here and say that the liabilities are 3,000. And that means that the owner's equity is negative. So that means the bank's bankrupt, which is bad. All right, so we will get more into the weeds of other stuff related to banks momentarily, but this is a good introduction, hopefully, for you to understand balance sheets. I'll see you next time.